Welcome to this explainer. I want to kick things off today by challenging a deeply held, yet completely assumed, truth in the market. Over the past couple of years, if you wanted to understand the massive run-up in AI, you really only needed one simple equation in your head. Nvidia equals AI, right? If you couldn't buy a piece of OpenAI directly, well, you bought the company selling the shovels. Nvidia, TSMC, the big four cloud providers, and for the last 24 months, that logic has been absolutely bulletproof. But here's the counterintuitive idea we're unpacking today. That logic, it's expiring. Now, to be clear, AI capital expenditure is not peaking. It's actually accelerating. But what's changing, and changing rapidly, is the destination of all that money. The market is trying to navigate this next phase of AI using an outdated map, and that creates massive opportunities, but also some pretty terrifying risks. Okay, let's dive into this. To make sense of this transition, we're going to systematically break down how the AI infrastructure market is radically shifting to its second act. We'll hit the AI Capex shift, the memory bottleneck, de-Nvidiazation, the financialization of compute, counterarguments and risks, and finally, some future predictions. All right, part one, the AI Capex shift. And this brilliantly illustrates the sheer scale of what we're talking about. Nvidia's management projects AI infrastructure investments could hit a staggering $3 to $4 trillion by the end of the century. The money is absolutely there, but the destination is fundamentally transforming. Act 1, think 2023 to 2025, was entirely training-driven. Compute was literally synonymous with GPUs. The bottleneck was Nvidia's supply chain, and the buyers, they were almost exclusively the big four hyperscale cloud providers. Basically, whoever was closest to the GPU won. But Act 2, zooming into 2026 and beyond, flips the script entirely. It's inference-driven. The bottleneck moves completely away from the GPU itself, down to memory, interconnects, and power. Plus, the buyer profile explodes from just 4 major clouds to sovereign nations and Tier 2 cloud providers. So why is this happening right now? Well, over the past few months, several seemingly isolated market signals have been flashing all at once. We're talking OpenAI partnering with Broadcom for a custom chip, SpaceX leasing out GPUs, the VC firm A16Z backing Tier 2 cloud infrastructure software, Amazon pouring $13 billion with a B into AI infrastructure in India. Make no mistake, folks, these aren't just random news clippings. They are highly coordinated signals that the curtain on Act 2 is officially rising. And here is the driving force behind it all, 1 billion. According to Nvidia's Jensen Huang, inference compute demand is going to grow by 1 billion times. Insane, right? Why? Because the entire paradigm is shifting from one-time generative queries to what we call thinking models. We are stacking scaling laws across pre-training, post-training, and inference. Honestly, the sheer scale of inference is about to absolutely dwarf everything we've seen so far. Which leads us perfectly to Section 2, the memory bottleneck. As workloads shift from training over to inference, the core physical friction point in the whole AI ecosystem physically moves down the tech stack. In Act 1, everybody just wanted a GPU, which gave NVIDIA absolute pricing power. But remember, training is a one-time, highly centralized process. Inference, on the other hand, it's a continuous, decentralized grind. You have to constantly shuttle massive data weights in and out while trying to charge just pennies per token. Therefore, the new bottleneck isn't peak floating point compute anymore. It's how cheaply you can actually produce that token. And that process is heavily constrained by memory capacity, bandwidth, and power. So the crucial point is really captured by this number right here. $550 billion. That is the massive commitment South Korea's memory giants have just made to expand their capacity. Think about it. The companies that understand cyclical hardware better than literally anyone else are betting with cold, hard cash that memory is the true bottleneck of the inference era. This is a sector that was almost entirely overshadowed by the GPU hype during Act 1, and now it's taking center stage. Moving right along to Section 3, de-Nvidiazation. Now, let's be clear. De-Nvidiazation doesn't mean NVIDIA suddenly loses its dominance in training. Not at all. But it does mean its ceiling in the exploding inference market is significantly lower than everyone currently assumes. Training requires the extreme versatility of NVIDIA's general-purpose GPUs and its CUDA software ecosystem, basically because you just don't know what the next model architecture is going to look like. But inference? Inference is highly deterministic. The model is set, the workload is known. And when a workload is massive and predictable, buyers are heavily incentivized to ditch general-purpose hardware for custom application-specific integrated circuits, or ASICs, to drastically slash costs. Actually, it's just like what we saw play out in Bitcoin mining, right? Moving from general GPUs to dedicated ASIC miners. So, who are the new shovel sellers? When OpenAI designs its own custom chip, it isn't just some fun novelty project. It is a massive directional signal. It means that in the inference era, companies like Broadcom, who helped design these custom chips, and emerging Tier 2 cloud network software providers are stepping directly into the spotlight. The beneficiaries are rotating, plain and simple. All right, Section 4, Financialization of Compute. This brings us to what might be the most fascinating and, honestly, the most dangerous shift yet. The fundamental nature of compute as an asset is evolving globally. Take a look at this number, $150 million. That is the monthly cash flow SpaceX is generating right now simply by leasing its data center GPUs to an AI lab called Reflection AI on a 3-year contract out to 2029. Let that sink in. Elon Musk's rocket company is effectively acting as a massive compute landlord. Now, what's really interesting about this slide is the profound implication of that SpaceX deal. AI compute is no longer just a line item hidden away on the balance sheets of the big 4 tech companies. It is transforming into a decentralized asset that offers highly predictable rental cash flows. And when something offers predictable cash flows, it can be leveraged. We're now seeing a global buying frenzy fueled by Tier 2 clouds and sovereign infrastructure races. But here's the catch. This financialization creates a classic vulnerability. We call it the leverage trap. Let's walk through the steps. Step 1. Tier 2 cloud providers borrow heavy debt to buy GPUs, making a huge bet on future rental income. Step 2. Those physical GPUs typically depreciate over a 3-year timeline. But then there's Step 3. AI software models become obsolete every 18 months. You see the problem? This creates a terrifying maturity mismatch between debt, hardware lifespan, and software relevance. If we hit Step 4, meaning even a slight miss in expected inference demand, this highly leveraged cycle can reverse violently, and that infrastructure bubble bursts. Let's move to and see how this builds into a clear framework for understanding the new market landscape. At the bottom layer, base compute with Nvidia and TSMC is still core, but honestly, it's mostly priced in. It's market beta at this point. The real action is in the middle layer, inference infrastructure. We're looking at Broadcom, custom ASICs, and high bandwidth memory. And looking even further ahead, the top layer is data and application. As the AI models themselves become commoditized, the ultimate competitive moat becomes context engineering. That's Databricks logic, basically having the plumbing and infrastructure in place to feed the AI the exact right data and permissions at the exact right moment. Which brings us to Section 5, Counterarguments and Risks. For the sake of absolute intellectual honesty, we have to neutrally examine the strongest opposing views to this entire thesis, because they are highly credible. Here's the primary counterargument. Skeptics point out that Nvidia isn't blind to the memory bottleneck. In fact, their newest architectures tightly integrate memory, interconnects, and CPUs right into a single holistic system. From this perspective, even if the bottleneck shifts entirely to memory and power, Nvidia is perfectly positioned to capture that value within its own hardware ecosystems. If that's true, de-Nvidiaization is a totally false premise. The second major counterargument questions our core assumption entirely. What if inference demand doesn't actually explode by 1 billion times? What if it's mostly just a narrative spun up to justify more financing? Because if real-world, profitable enterprise demand doesn't actually materialize, then that financialization we just discussed won't expand the market. It'll just accelerate a massive, devastating bubble. Finally, Section 6, Future Predictions. So how do we know who is actually right? Over the next 12 to 24 months, if the Act 2 thesis is correct, here are the specific signals that will verify it. First, watch for lead times on memory and high bandwidth memory to tighten up significantly. Second, watch for the market repricing of memory companies to begin outpacing the standard GPU hype. And third, look for extreme volatility in the power and cooling sector. We've already seen companies like Vertiv swing wildly up and down in a single week. That tells us the market knows power is a bottleneck, but just hasn't figured out exactly how to price it yet. On the flip side, here is exactly what would invalidate this explainer's thesis entirely. If memory prices actually loosen and drop over the next few quarters, well, the bottleneck shift theory is wrong. If inference utilization rates drop, then that demand bubble is very real. And if Nvidia actually gains market share in the inference space while custom chip efforts stall out, then the counter-arguments win outright. I want to leave you with this provocative final thought.
We are entering a phase of incredible technological opportunity, but it's layered over severe financial fragility. So watch the market closely, because your portfolio might depend on this exact question. Over the next 12 months, will we see memory prices surge first, proving the physical bottlenecks of Act 2? Or will a highly leveraged Tier 2 cloud operator default on their debt, proving that the compute bubble has already burst? The answer to that question is going to define the next decade of technology. Thanks for joining me for this explainer.